My name's Aaron Barnfather. I'm a Managing Director on European Equities at Lazards, and today we're going to outline the case for why you should invest in Europe. We believe that expectations for Europe have become so bad it's actually good, as it's hard for Europe to disappoint from here, but it's very easy for it to surprise positively. European expectations and perceptions are that we will have low growth or even no economic growth, that negative bond yields are negative for the market, that the ECB has limited options in terms of stimulus, that we're effectively going through macro stagnation, and that Brexit and trade uncertainties will continue to overhang both the economy and the market. While it's very true that Brexit and trade uncertainties are not good in the short to medium term, there are many other things that we believe the market is misinterpreting. We believe that Europe is actually showing a relatively steady level of growth. It has a significant potential to recover, that the ECB has a number of innovative options at its fingertips for QE, and we believe that alpha opportunities in idiosyncratic stocks have the potential to allow outperformance in Europe in a range of environments. Economic data has clearly been disappointing in Europe of late. Sentiment has clearly been impacted by worries about global trade, as well as more homegrown issues like the stalling of car production due to new emission standards. The Eurozone Purchasing Managers' Index for manufacturing has fallen nearly every single month since the beginning of 2018, as has the German IFO Business Survey. Two things strike us about this. Firstly, expectations are already so low that the data points have not actually resulted in as many negative surprises as one might think. As you can see from the graph, particularly in the first half of the year when data was poor, the amount of economists that were actually surprised negatively diminished to the point that almost none were. While the second half has seen a drop in this graph, you can also see that it's rebounded quite quickly, just illustrating how low expectations are amongst macroeconomists at the current time. This means that while growth is low and will probably stay low, it's on a relatively steady state, which is clearly not what the market perceives at the current time. Also, this disappointing data has focused on the industrial sectors, while the larger consumer part of the economy has actually been more robust and also rebounded more over recent times. On the services side of the economy, we can see that the lead indicator, having fallen in the first half of the year, has actually rebounded considerably in more recent times. It's also noticeable that the employment data has been improving steadily for some period of time in Europe, since unemployment peaked in 2013. Unemployment is actually very low in Germany, at a record-breaking 4.9%, and it's clearly been falling in places like Spain and Italy as the recovery has taken place. Wage inflation measures, as shown in the graph, are now providing signs that tighter labour markets are slowly leading to higher pay, which indicates a healthier domestic economy than some of the top-line data might imply. The perception is also that there is no corporate or household loan growth in Europe. While that is true in some countries, it is clearly not true over all of Europe, as the graph illustrates. And again, this indicates a more healthy economy than investors perceive. What really makes Europe stand out is the level of optionality that it offers to global investors. Europe is a reasonably open economy that has lagged the growth rate of the rest of the world. If global growth picks back up, there is a massive room for profit recovery through both international and domestic companies, much more than in the rest of the world. This can be seen in the aggregate level of earnings recovery compared to other regions. European earnings remain 30% below their pre-crisis levels, while US earnings are almost 70% above, and emerging markets are close to flat. This illustrates the recovery potential in Europe far exceeds that of the global equity market, and could represent a powerful source of return for investors in years to come. Europe has a history of recovering more slowly, but ultimately catching up with global growth, and this cycle still has the potential to rhyme with other global recoveries. This is illustrated by the graph showing EBITDA margins for the MSCI Europe and US equity market. Margins have recovered from 2015 lows, but as you can see, still lag the US by a significant margin. That was also the case in previous cycles, but as you can see, eventually European margins caught up to be close to the same as the US as the cycle evolved. Europe's valuation looks very attractive on a standalone basis, but particularly versus equity markets in the rest of the world. As you can see, it is nowhere near its highs, and especially stands out when you look at the income that it produces, with a yield of 3.6%. What's more, this income is well covered by its cash flows, something that not a lot of the equity markets around the world can say today, with, for example, the US market paying out 105% of its cash flow in dividend. The valuations of European equities look especially attractive relative to bonds. Europe has the dubious honour of some of the world's most expensive bonds. However, that is not the case for its equities. As you can see from the graph, the Bund yield and the European equity market used to yield almost the same. Now the gap has become extreme, clearly illustrating how compelling equities are and how compelling they could become if negative yields start to put investors off from owning bonds. What investors need to think about next is the QE that we have coming in the autumn of this year. This will clearly differentiate the European region in a macro sense. This round of QE will likely be different to the last, as many of the government bonds that they bought last time are now on negative yields. We don't know exactly what they will do, but corporate bonds are likely to feature significantly, as bank debt may do. Some strategists are even speculating that the ECB could buy equities. Now, while we think that's relatively fanciful given where the ECB is in its thinking at the current time, it is noticeable that the Swiss National Bank has been buying equities as they've hedged their own currency, and QE could easily cause them to have to increase that hedging as time goes on. While the underlying macroeconomic data seems unexciting, the return on equity of the market actually bottomed out at 8% and is now above 12%. This improvement in returns illustrates the broadening of opportunities for stock picking. Like many equity markets, growth stocks have been performing very strongly in Europe, creating a somewhat bifurcated market. However, not only does this mean that there are a wide set of value opportunities available to us, there is also alpha to be had from finding companies that the market will come to see as growth over time, but do not fit into that classic mould today. Where Europe looks very different to the rest of the world is that a number of the areas that have performed well, because they are perceived to be safe haven stocks, are in some cases actually seeing a deterioration of their fundamentals, with return on capital declining, growth sometimes being lower than expected, and margins starting to come under pressure. This, we think, makes it much more important than normal to approach the market from a bottom-up basis in order to ensure that the sustainability of profits in this low growth and income world is real and not just perceived. On the subject of undervalued and undiscovered earnings growth, Europe has some notable examples. One of these is the professional publishers, that have gone from publishing just paperback books to being some of the biggest database and software companies in the world. They supply accountants, lawyers, and doctors with some of the most fundamental tools that they use on a day-to-day basis, while the professional publishers themselves get paid a growing income to do so. Another example is German real estate, where unusually investors can access residential property rather than commercial property. And these blocks of flats are in short supply, and the earning streams and rent rises are highly regulated, and it's also very mechanical in the way that rent rises go through, making these cash flows highly attractive when compared to classic defensive stocks like food companies, for example, that generally are now growing at half the rate that they've done so historically. The great thing about Europe is it is always doing something different to the rest of the world. It's well known for its luxury goods, travel and food, but it's also differentiated in many other ways that offer unique alpha opportunities. For example, as technologies become more networked, Europe has a range of leading companies from everything from ERP software through to nanotechnologies. Shareholder value is also being enhanced by a significant shift in the industrial space to service-based business models. European management teams are also becoming well known for reversing conglomerate cultures and improving financial productivity through decentralization. And finally, Europe remains at the forefront of a number of consumer trends, whether it's organic sourcing of ingredients or the downloading of music. So in this brave new world of low economic growth and negative yields, we believe that Europe stands out. Partly because its growth dynamics are misunderstood, partly because it offers optionality on any resolution on world growth. Definitely because its valuation stands out relative to global equities and against other assets in its own region. But we do think that it's extremely important to approach this from a bottom-up basis in order to avoid some of the risks. And on a bottom-up basis, we can also see some alpha drivers that look very compelling no matter what the environment we find ourselves in next.